Buenos dias. Hello to everyone. Welcome to Virtual Investment Summit, organized by Fund Society and BMO Global Asset Management. My name is Madina, and today we're going to talk on how to generate alpha by investing responsibly through integration of ESG factors, management, measurement, and engagement. The speakers of today's event are Nick Henderson and Vicki Bakhshi. Nick Anderson is a portfolio manager within the Global Equities team. He is alternate portfolio manager of the BMO Sustainable Opportunities European Equity Fund, lead portfolio manager on the Sustainable Opportunities Global Equity Fund, and alternate portfolio manager of the BMO Responsible Global Equity Fund and the BMO SDG Engagement Global Equity Fund. Vicki is the director of the BMO Responsible Investment Team. Her focus is on advising the firm on climate change and impact reporting. She also engaged with investee companies in the utility sector, encouraging best practice and sustainability and governance issues. Both Nick and Vicki today will talk about different ESG topics. And of course, I would like to present you the host of this event, who will moderate and make this event even more dynamic. This is Marta Campeyo. Marta has been working at Abante Accessories since 2012, and where she initially acted as the head of the retail sales department. For the last 14 years, she has been a member of the asset management team, sharing the role of absolute return fund selector and portfolio manager. Since 2018, she is also the director of the Portfolio Advisory Division. She became a partner of Abante Accessories back in 2009. Before we start the event, I would like to remind to all of you that you may make your questions in the Q&A tab down on the right side of your screen, both in English or Spanish languages, and we will address them to our speakers in Q&A session by the end of this event. So let's get it started. Hello, Marta. How are you? Nice to see you here. So I just realized that you've been working at Abante Accessories since 2002, but I said it was my mistake to say that it was 2012.
So I look younger. Marta, I look younger. That's a fact.
For sure, you look amazing. Well, Marta, thank you so much for your participation. We really appreciate it. So please take the lead and break a leg.
Thank you very much, Madina, and thank you very much to Fund Society for holding this event. I will say hello to our presenters, Nick and Vicki. It is my pleasure to be here with you. And I think we have a very interesting topic to discuss about. It's about responsible investment, ESG. And maybe we can kick off this conversation. And I will address my first question to both of you, because I think, the audience and myself in the recent years, we've seen a growing interest about ESG investing. And according to Morningstar, last year, almost 40% of the inflows into the fund industry were received by ESG funds, which is really a great interest into this topic. But we have like very different approaches to ESG investing. I mean, there are people that have apparently no interest at all in the topic. Then we have like this exclusions approach. Step forward is just to choose the best in class, but I am sure that you have a very unique approach to ESG investing, and maybe you can share with us what kind of things you think you do differently from others. You have a very long experience in the ESG investing, and maybe you can share with us, your response to this topic.
Great to be here. Thanks, Marta. Shall I kick off maybe? I think when you look back at the beginning of responsible investment, there really was only, so we've been working on this for more than 30 years. And back in the beginning, there were only really two options. There was ethical investment and there was everything else. And really the only option if you wanted to align your values with your investment was screening, was screening out companies or divesting companies in sectors like tobacco and weapons. And I think the big change that you were just talking about and the growth of interest has been the realization that these environmental, social and governance issues are not just ethical issues, but they're also financial issues. And we saw many examples of where companies who've neglected these issues ended up with massive financial loss, like BP and Deepwater Horizon, like the banking crisis, like the collapse of Enron. And what's happened is that led us for a lot of the ESG, looking at ESG issues is just good investment analysis, and it's part of identifying risk. And that's been our belief for a long time. What's happened over the last decade, I think, is that's been really backed up by evidence. And it's hard to prove any simple connection between ESG and performance. But we looked to the literature and found some really interesting findings. So one from the University of Oxford looked at over 190 studies, and they found that nearly 90% of those showed that companies with strong sustainability demonstrated better operational performance. There are also other studies, like one from MSCI, showing that companies that have got positive ESG momentum, so maybe they didn't start off great, but they're improving, that also can have a connection with improved performance. So we've got much better data now, we've got much more evidence of the benefits of ESG. And I think that's really opened up the market to a much wider range of products. So we integrate ESG across everything that we do, every fund that we have across every asset class. But we also have products, and including the ones that Nick runs, which offer enhanced ESG credentials, which do screen out companies and which do really focus on sustainability solution providers. So I think the mix of approaches and products available to clients is now much richer than it was back at the beginning.
Nick, would you like to add something?
Absolutely, I'd love to. I think just to jump on what Vicki was saying, I think something that we do that we're incredibly proud of is really spanning across, I think, the three most important aspects when we're thinking about investing in this way. The first that Vicki talked to is ESG integration, which for us is just done across every single strategy that we run across BMO, simply because this is the best way to invest. By taking a well-rounded view on every single business, that enables us to make the best decisions from a portfolio management perspective. And that includes thinking about ESG risks and opportunities. So that's the first point. The second point is that something that I think is absolutely critical is engagement, is working with companies and having an impact in the way in which these companies are operating, and really trying to help them on their journey to become better businesses, to reduce risks and to embrace opportunities. And then finally, it's our ability to report back on that, and you know, hopefully in due course, during this conversation, we'll talk about it. But absolutely. So going back to what Vicki was saying, ESG integration is put across all the strategies that we run. But the strategies that I run myself really try and go a step further to really think about the most salient points from an ESG perspective, and really to capitalize on those, to embrace those. And yeah, absolutely, there's a vast amount of research out there that points to the benefits of investing in a responsible manner. But then also, if you take a step back and you think, well, okay, let's embrace all of these risks and opportunities. Let's be fully aware of them. Let's think about the issues in supply chain management and labor standards and so on. And let's try and protect ourselves and our portfolios from that risk. But then equally, let's think of the multitude of sustainability challenges in the world around us, and let's find those solution providers and invest in them, and then really find that growth tailwind is at their back to really drive portfolio performance. So that we've seen strong, as Marta, as you mentioned, strong asset growth in this space, and I think really it's going to continue because the very building blocks of the way in which we invest is incredibly robust from a risk-reward payoff.
I think we have touched in this first question two aspects that are quite important for investors. The first one is that we are seeing that investors need to probably find a sense now when they invest. So this ESG criteria meet a part of what investors want for their money. But the second leg is, as Nick was saying, performance, because at the end of the day, everyone wants to earn money, and this is a way of doing it. I think there is a third leg, which is also quite important, and Nick just have mentioned it, but it is about risk. And you, Vicki, mentioned before a lot of studies and papers from academies and scientific papers about performance and measurement, but is there any evidence that ESG criteria or responsible investment also mitigates or helps to mitigate risk when it comes to investments?
Yeah, absolutely. We think there are, and I think there's certain areas of the market that you can really point to that are where we are mitigating risk. I'll take one example, and that is the energy space. There is mounting concerns around stranded assets, for example, and the impact that risk will have upon the businesses that have these fossil fuel reserves. We take a view that actually investing in conventional energy is not aligned with the way in which we want to invest from a responsible perspective. But if you take a step back, and actually the risks inherent in that market do make it quite a dangerous place to invest from a risk return profile. Now, there's an argument that the value is there from a short-term investment perspective, but in our perspective, then actually that is perhaps more of a value trap right now. So we happen to exclude investing in fossil fuels because of that, the ongoing challenge around that and the emissions and so on. But we think that what has happened within the energy space is good evidence that actually investing in a responsible manner and embracing the opportunities of renewable energy, for example, that is a much more powerful way to invest and does mitigate risks. If I take another example about risk mitigation, if we're talking about to move into the apparel industry, for example, there are a number of different examples where poor practice from a labour standards perspective have resulted in both reputational and financial damage for businesses involved. So if we think back to 2013, the horrific collapse of a factory in Bangkok, Rana Plaza, the benefits that we have at BMO and the real strength of Vicki's team, our responsible investment team, mean that we're able to really think deeply and send people out to areas of controversies and to ask questions, to talk to companies about what's going on. So we had someone on site back in 2013 at Rana Plaza. They went back a year later to really see what changes had been implemented. And we can then take that experience forward and think about how we apply that to existing portfolio holdings. So when we're invested in the apparel space, we look for best practice management around supply chain management, around how they work with their supply chain to mitigate those risks, to drive that better risk reward payoff.
very much, Nick, and thank you for using examples, because I think that helps us to better understand what this kind of means. Vicki, in my humble opinion, I think this COVID environment that we are living now has boosted interest for ESG topics. But as you mentioned before, there are different angles when looking at ESG. Have you noticed any changes in the importance that people give to different aspects? For example, do you notice that now people are more focused on social factors rather than environmental issues? Or do you think that this is like something that you should consider as a whole at the time?
Yeah, I think COVID's had, it's had a monumental economic impact, but I think it's also had some really fundamental impacts on responsible investment and on the environmental, social and governance issues that we look at. And we published some pieces on this, we published 8 pieces this year on this topic, and we've looked at a whole range of impacts that we've seen on corporate responsibility, on issues like labour management, on the fight against plastic waste, as we've had more personal protection equipment, there's more plastic waste, impacts on the food production chain and getting safe food distributed around the world, on corporate governance, so the ability of companies to hold annual general meetings and what they've done when they haven't been able to hold those in person, on climate change, as we've had massive impacts on travel and transportation. So it's really wide ranging across the spectrum of ESG, and I think some of those impacts will be felt after this crisis ends. But I think you're right to say that the social impacts have been particularly prominent, and that there were existing issues there to start with, like the issues Nick was saying in the supply chains, and it's made those much more visible and more apparent. And I think the crisis has really highlighted companies' responsibilities to their workers, to the staff and their supply chains, but also more widely to their suppliers, to their communities, as we go through an extraordinarily difficult time. And we've seen a really big difference between companies who've looked after their staff in terms of getting a safe working environment, providing sick pay, providing help to people who've suddenly got young children at home, between companies that have done that well and companies that have done that badly. And companies who've done it badly have been called out in public. So I think it's really highlighted and brought forward issues that we knew were already there, but perhaps weren't as prominent as they should have been. And certainly that's guided the way that we analyse companies and the engagement that we've been doing. At the same time, I think it'd be wrong to say environmental issues gone away. Climate change, perhaps we'll come back to this, but one of the impacts has been that we've had to postpone the big climate conference, which was due to take place in the UK this year. That's now happening next year. So I think climate change will continue to be important. So I think it's not about anything getting less prominent, but I do think you're absolutely right that the social issues have come to the forefront, and just the idea of our interconnectedness and the fact that we do have responsibilities to each other, and companies aren't just responsible to their shareholders, but to all the stakeholders that influence.
Thank you, Vicki. I will come back to Nick now. Nick, Vicki mentioned before that in BMO you have around 30 years of experience in ESG investing. The fund you run, this strategy was launched in 2005, so it's been a while since you are engaged in this strategy. The ESG investment approach help you to identify better opportunities and ultimately to generate alpha, which is the title of this debate. And I mean, you have a lot of years of experience to share with us if this has been a tailwind for you and for your strategy.
Yeah, absolutely, Marta. And the strategy you talked to is our flagship responsible global equity strategy. Absolutely, the CCAP launched in 2005. But the heritage of the portfolio goes back into 1987. So we've got a long track record, and we've been investing in this way for a long time. But something that actually that Vicki mentioned was about the transition that we've seen for these portfolios moving, and this portfolio, our strategy is no exception. It started its life back in the 80s as purely a negatively screened ethical fund. But in recent years, going back the last 10, 12, 15 years, we've really tried to embrace the sustainability challenges. And so now we run, and have done for a while, a very clear philosophy, I think, of avoid, invest, and improve, to really, first of all, exclude those companies that we think we want to avoid with damaging or unsustainable business practices. But really, more focus is applied to the invest and to the improve. To invest in companies that are addressing sustainability challenges and driving the world to a better place, and are really benefiting from tailwinds. And not directly to your question about the opportunity set. If we think about the sustainability challenges of the world around us, we can think about aging demographics and the impact that has on the healthcare system. Right now, absolutely going back to your previous question around COVID, the societal impact that COVID is having upon the healthcare chain, alongside aging demographics and rising obesity and so on, that is putting a huge stress on our healthcare systems, as are the fiscal challenges that government are applying to it. And so we need to find companies that are delivering better healthcare outcomes, better diagnoses to deliver those healthcare outcomes, to drive a more efficient healthcare service. And so investing in a company like Thermo Fisher, providing not just COVID tests, and they're doing that right now, but equally oncology diagnoses and so on, that is really allowing better healthcare outcomes, and so they are benefiting as a result. Another example in a totally different space is in the financials. There are 190 million people in India that don't have a bank account. They don't have that financial security. And so we think we found a company that is really delivering on addressing that challenge. They are educating, so HDFC Bank is a company we own within the portfolios. They are educating rural individuals around the benefits of financial security. And so they're seeing strong deposit growth, and that is financing strong loan growth. And so this becomes a circular benefit for the consumer, for the company, and so they're a strongly profitable bank in India that is performing well. So there are many examples where, by identifying these sustainability challenges and then finding the high quality, and quality is critical, that allows the long-term outperformance, we believe. The quality investment solutions that are providing that is what we think underpins the alpha that we've been generating for a number of years, and talk through performance in due course. We're proud of the track record we have, and we look to continue doing that going forward.
Thank you. Maybe after, touching on the benefits of investing responsibly, maybe now we can share with our audience things that are also important. I think, and I see from what you are talking about, that this ESG investment implies some complexity in analysis, in measurement, in integration, both with the asset management team and the ESG team. And maybe we can talk a little bit about what is Vicki's work, and what does she and her team do, and how they can help the managers to integrate all this hard work.
Sure. So I'm part of a team of 20. So we've got a really large internal resource of 20 experts across the range of environmental and social and governance issues. And I guess we've got sort of two main roles in the business. One is supporting ESG integration. So we're there as a sort of center of expertise We share data, we share research with the fund managers. But really, this is about much more than data. And I think when we think about ESG data, it's useful to have it, but really it's only ever a starting point. And if you're going to do ESG integration properly, it has to be a really meaningful, integral part of the investment process. And so something we put a lot of emphasis on is internal education. Because if you think about it, ESG generally isn't a big part of fund manager training. And if you're going to use this ESG data and research in a meaningful way and really understand where it's material, where it's not material, and how it fits into company valuation, you have to have a good understanding of what those ESG issues are. So we run an internal webinar series that we run for our portfolio managers. I did one recently on climate change. We've done ones on human rights, on cybersecurity, on the Sustainable Development Goals. So we really want to equip our fund managers to understand how ESG can be relevant to their investment decisions, the way that Nick was just talking about. And then the other role that we have is really post-investment is stewardship. In other words, we oversee the company's program engagement with the companies that we invest in, and also proxy voting. So in 2020, within our team, we engaged over 700 companies on the whole range of environmental, social and governance issues. And that includes companies that we invest in directly, but also companies held by our clients of our third-party engagement service, Rio. Engagement together with the voting is really part of our attempt to work with our investee companies to improve their management of ESG issues.
I have liked very much the expression you have used about regarding equip our investment managers. I think it's very, very appropriate way of saying it. You have just mentioned engagement, and I think this is one of your strengths when using this approach. Can you elaborate a little bit on it? And do you think that this is probably a changer when it comes to the relationship you establish between you as investment managers and the companies you invest in?
I think it is, and I think it gives us a much broader understanding and a deeper understanding of the companies that we're investing in ultimately. So engagement describes the dialogue we have with companies. That might be a combination of meetings, letters, emails, all of which is aimed to sort of give us a relationship with that company and understand the ESG issues they're facing. And I think, we look at ESGs as part of the company evaluation process, and no company is perfect. There's always something that comes up and somewhere companies can improve. And our aim through engagement is really be a partner with companies. So rather than just trading shares, we want to be an owner, and we want to be an active owner, partner with the companies that we invest in. We have those meetings with companies. We'll long examples of best practice. We'll help them understand what their peers are doing. We'll help them understand what investor expectations are. We'll try to put items on the agenda for company boards, so sort of elevate their importance and accelerate what companies are already looking at and already doing. And that approach helps us to deepen our understanding. It also fits the long-term perspective that we have as an investor in companies. It's worthwhile us to put that time into building the relationship, because when we buy a company, we want to be holding it for a long time. So that really helps us to have that long-term perspective to make that engagement more effective.
That's very interesting. As I am not an expert, and you are, let me ask you if this engagement is it well understood by companies, or have you had any experience of being as interference in their activity or in the way they want to run the business? And maybe you can provide us with any example of a successful relationship where you have seen, for example, a positive contribution to the environment or society from this kind of relationship with the companies.
Sure. I mean, I've been with BMO 14 years, and when I started, I think sometimes that was the reaction we got. We went and talked to a company, and, well, why are you asking us about this? Can't you just buy our shares and go away and get with it? That is not the case now. It's very rarely the case now. I think now companies almost see us a bit like free consultants. We'll come in, we'll sort of spot where their weak spots are and help them identify those and help them deal with them. On the whole, I'd say the relationship is very positive. I think the regulators have really helped with that by making it very clear that this is, you know, this is a legitimate investor activity. It's part of our fiduciary duties. So I think that has changed. I think we still sometimes get a bit of pushback with some companies where there isn't that history. I think it's tougher in some markets than others. It's tougher in some emerging markets. It's tougher sometimes in the US. But I think generally, and particularly in Europe, the relationship's genuinely very constructive. To give you a couple of concrete examples, two very different examples. One is that we collaborate with 500 other investors in an initiative called Climate Action 100 Plus. And that now represents $47 trillion in assets under management. So it's the largest ever investor collaboration. And that sort of weight of assets, I think, reflects what we were saying earlier, is that this has really taken off, this whole ESG thing. It's much more mainstream. And we're talking to over 160 companies. And those companies make up 2/3 of global greenhouse gas emissions. So if we can get those companies to shift, then really we're a long way towards solving the climate crisis. And through that collaboration and through the sort of unified voice coming from investors, we have seen commitments come from companies, and I think those commitments have come faster than they otherwise would have done. So to take an example in the oil and gas industry, Repsol was one of the first national oil and gas companies to announce a target of net zero emissions, and now all 6 of the sort of the European majors have followed suit and all have those kind of commitments in place. Different type of engagement is something we've been doing much more one-on-one, is talking to apparel companies. Nick mentioned this earlier, clothing companies. The risks actually are mostly in their supply chains, and we've been pushing them to improve the control they've got on child labour and forced labour, modern slavery. And most recently, we've been talking to companies like The Gap, the US clothing company, about their suppliers in India, because as a result of COVID, in some states of India have relaxed their labour laws because they're worried about the financial impacts of COVID on apparel companies. Well, that can have a really bad impact on workers in those companies. So we've been talking to clothing companies to really keep up their standards at this difficult time.
Thank you, Vicki. Nick, I have not forgotten you, but I think it was important to understand what Vicki's team does, and maybe you can tell us how does your team interact with Vicki's?
Absolutely, and Vicki's far too British and polite to identify this, but what she does, what her team does to enable us on the portfolio management side is critical. You know, if we're going to be consuming ESG data and digesting it and fully integrating it into the work that we do and into every company that we look at, we need that expertise in order to do so. Now, there's a number of different avenues that we can acquire some sort of ESG data. There's third-party data providers, Sustainalytics, MSCI ESG, research, and so on. But every time we look at those, whilst it is valuable, we do happen to continue to see challenges in some of the depth. The depth of their coverage is great. Sometimes when you really look at the granular detail, there are some aspects that are missing. Having the strength internally to critique analysis, that is invaluable to what we do. So we actually happen to have you know, our own scoring system where we take third-party data but clean it up a bit and make it more appropriate, and we embed that into every single company valuation that we look to think along. You know, if we think about the DCF, we look at the revenue lines, the margins, and to really ensure that we're looking at the opportunities, we're factoring in the risks, And to get a bit more granular detail, we have been talking about aerospace, so I may as well continue on that. We own a company called VF Corp, which is the owner of some brands such as the North Face and Timberland, and these sort of active lifestyle brands, getting people active. But our experience that we have through looking through supply chain management issues, and more importantly, engaging with companies, that enables us to think more deeply about the valuation of that company. So when we talk to the CEO and CFO of VF Corp, we're talking to them about mitigation strategies they have within their supply chain to offset potential challenges. So the fact that they are putting money to work with their suppliers to mitigate challenges around fire safety in a factory, for example, that is of meaningful benefit to the business, because if a factory, the supplier factory goes offline, that is of financial impact to VF Corp. So we are able to evaluate these challenges, put a monetary value against it, and then integrate that into our valuation work. And so absolutely it's critical to have Vicki on our side.
Thank you very much. I think there is a last aspect we should talk about, and it's quite important for investors, and it is impact. Normally, when we talk about impact investing, we referred, or in the past, refer to illiquid assets, normally bonds, but maybe we can change investors' minds, and we can apply impact investing to our liquid world and for listed equities as well. Maybe both of you can answer to this question, but I would like to remind our audience, and if they have the opportunity, I read your ESG profile and impact report of 2019. It is really, really interesting. It has a lot of information, but after explaining us what you understand by impact investing, maybe you can tell us, how do you measure impact with your ideas? Because I think this is a very important aspect, and it is not very well known for us. Thank you.
Sure, I'll start. And then Vicki, maybe you want to jump in. But actually, interestingly, Marta, we'll get you the latest edition. There is a 2020 edition for you that was published relatively recently. So we'll get that to you, and that's even more information for you. But no, we think about impact really through two different avenues. There is the impact of companies that we're invested into the world around them, and then there's the impact we can have on those businesses. Through engagement, through Vicki's great work. We look to focus on across both of those different avenues, and really try to look at the materiality of these impacts. So I can give you some more examples. We touched on HDFC Bank in India. They have a system where they have a sustainable livelihood initiative, really trying to instill more opportunities for women within India. So they're now training. They've trained over 4.1 million women in India around financial knowledge, and train them up in terms of financial literacy. Equally, they also worked to open up credit markets for these individuals who might have gone to experience higher credit rates as a result of the roots of the Indian market. So a multitude of different women across India, and that is the benefit to them, because they're seeing that loan growth, and so it becomes that circular benefit that I was talking about earlier. So they are having a direct impact into the local economy, and they're benefiting as a result. So that's sort of one example where these businesses, it's a listed business, but it is having a direct impact into the world around them. And then we talked about the impact that we can have in terms of our engagement activity. So working with corporates to drive a better world, Kerry Group is an Irish ingredients business that we've been engaging with for a number of years, and we're really finding that that collaborative conversation we're having with them is driving change. They saw a 9% reduction in their water intensity last year. They are they've educated over 1,000 farmers in conservation agriculture techniques. So that through our engagement and our work with them about how they can improve their supply chain, they are changing the world around them as well. So it's a dual aspect of the impact that our investing companies can have, and we can come on to measurement in a second. There's also impact we can have through engagement. And Vicki may have a couple of words.
Vicki, I borrow a sentence from your report, and you say that if you can measure it, you can manage it. How do you measure it?
Yeah, so I think one of the we've got now is that we are seeing the word impact around everywhere in responsible investment, and there's not much consistency in how it's being reported on. So the main tool that we use to report, the main framework that we use is the Sustainable Development Goals, which are 17 goals for a more sustainable world by 2030. And through using that as a framework, we're able to map the two aspects that Nick just touched on. We're able to show how the companies we invest in through their products and services are supporting sustainable development. And we're also able to show how our engagement, encouraging better practices and some of the issues we've been talking about, how they're able to support sustainable development. So we try and be as transparent as we possibly can be about that. It's really challenging because companies themselves don't necessarily report in a consistent way, and we're working really hard to improve corporate reporting. One area, for example, is on social issues. We just said how important they are, but the reporting on things like how companies are treating their workforces, what kind of standards they've got in place, is very patchy. So we support something called the Workplace Disclosure Initiative to try to improve that reporting. So we've got some challenges in not having consistent data ourselves, but we've worked really hard to develop these methodologies so that we can be as transparent with our investors as possible.
Thank you, Vicki. I think it will be interesting to allow some minutes to present your BMO Responsible Global Equity Fund, Nick. Sorry, if you want to do it, and after that, I will address to you the questions from the audience. We are receiving a lot, so our audience to make more if they want. But Nick, the floor is yours, and we will listen to you.
Sure, absolutely. So I'll try and keep this quite brief because the Q&A would be to get to. But if we move on to the next slide, if we will, and actually the third slide, then this will give a sense of what we're trying to achieve within our responsible global equity strategy. That is to focus on quality growth businesses addressing that sustainability challenge and use our role as investors for active ownership and to go through the engagement work that we've done. So the next few slides, I'd just like to bring that in terms of how we operate. So the next slide, thank you, that's perfect, gives a background to the strategy, both from the objectives to invest in companies making a positive contribution to the world around us, but also some other factors such as to give a sense that it's a big fund and we're excited by the growth we're seeing in the fund. But actually, I think that my takeaway that I want to get across on this slide is the benchmark. Now, it's a very simple point, but by benchmarking ourselves to the MSCI World, we very deliberately want to identify that this is, to all intents and purposes, a high-quality global equity fund. Now, it has at its back the tailwinds associated with sustainability challenges, but we think this strategy should go toe-to-toe with any other global equity fund. And so that's why the benchmark is in the world, and our peer group is the broad global equity peer group. If we move to the next slide, we have the avoid, invest, improve philosophy. And that is really trying to ensure that we are mitigating risks as best we can associated with industries and bad practice, and also companies of bad practice. Then we want to invest in companies making a positive contribution to society and the environment. As we talked about, engage with companies to drive that positive change. Now, if we move to the slide, I'll give just a very brief overview of how this builds into our strategy from a regional perspective. We do have exposure to markets and to which is the other you can see there, and then also Japan, and that is funded by some underweight to North America, where valuations are a little more stretched. And then the next slide, you'll see the sectoral exposure, where we take a higher exposure into tech and healthcare and materials, where we think there is a real opportunity for the addressing of sustainability challenges. So that is our focus. That is where we think the most exciting opportunities are. The next slide will give a sense of some of the stocks that we own within the portfolio. You see the top 10 holdings on the left there. Actually, more meaningful to portfolio performance is the right-hand side, the top and bottom relative weights. So we have exposures such as Thermo Fisher, which I talked about earlier, in terms of their delivery of superior healthcare diagnostic equipment. Linde, the industrial gases business, right at the forefront of energy transition through the provision of hydrogen. Also, they're providing oxygen into hospitals right now to help with the coronavirus pandemic. And then, but I think also interestingly is our real thinking around the FANGs. You know, we are underweight the FANGs pretty heavily, as you can see on the bottom right of that chart. And it's because we think we can find some more differentiated ideas elsewhere in technology. But then also we do have ongoing concerns around the potential impact of regulation and which we might see as a result of the monetization of personal data that we see across a number of these businesses. So that's an ongoing concern, and I think that is an area of differentiation that we have relative to a number of other sustainability funds. On the next slide, you'll see what this really transpires into, which is a bit of performance. And you know, we're proud of the performance that we've been generating. So here you can see the slide net of fees. And looking through the multi-year period, we've had a good year in the last 12 months. But actually looking through the longer time frame, the 5 years that we've been 5 year plus, you know, we're 8th percentile against the broad global equity peer group. And so we're pleased with the performance that we have by trying to deliver on this very deliberate, robust and repeatable process with which we think we can identify these sustainability challenges. So there's the financial performance, and on the next slide you'll see a very snapshot of some non-financial performance. So in just the last quarter alone, we've seen, you know, real change within some of these businesses. So we've seen some corporate governance change at Linde by improving their relation of executive remuneration to incorporate more performance into their pay, and we think that makes better decision making. But then SMC, I think, is a really good example of a tech business that really understands change. You know, they have always led in terms of, so they're a chip manufacturing business based in Taiwan, and they've always led in terms of water management. But recently, last quarter, committed to acquiring the power output from a wind farm off the coast of Taiwan, because they recognise the challenges associated with climate change, and they want to future-proof themselves against that. Now, they need a lot of energy, but they want to procure it in a renewable sense and reliable way through the offshore wind farm owned by Ørsted. And very finally, if we go to the next slide, I want to touch on something that, you know, we haven't really talked about today, only through Marta, through you kindly mentioning the impact report. Reporting is critical. Our ability to identify and then communicate the way in which we approach responsible investing to our client base is absolutely critical. You know, there is going to be an increasing scrutiny on these. You know, we've seen, Marta, as you mentioned, there's been a groundswell of interest and of asset flows into this space. But I think with that is going to come an increasing scrutiny in the way in which asset managers operate. And so that is why we've been so transparent. So on the screen, you can see the 2020 report that we published for the impact report. We've got them going back to 2015, where we started pretty early in trying to evidence what we do from a sustainability perspective. And on the next slide, you can see an output of that, which Vicki mentioned, which is using the SDGs, the Sustainable Development Goals, as a framework to really illustrate the portfolio. So we break down each businesses we own within the portfolio to their constituent revenue lines. It's an awful lot of work, but we need to do it. Break down those companies to their revenue lines and align those where appropriate to any of the 169 SDG targets that sit beneath the 17 goals. And so that provides granularity to identify the positive and the negative contributions that our companies that we own within the portfolio are making. So that disclosure is critical, and that is something we take seriously. That's why we produce these reports. So I'll pause there, and Marta, I'll hand it back to you, and looking forward to some Q&A.
Thank you very much, Nick. I am sure you have wake up the interest of the audience in your strategy. Very, very interesting. We have many questions. I will ask you to freely answer, both of you, when you want, and if possible, try to keep your answers brief, so as we many questions. This one is about if you have any bias to mid and small caps or to emerging markets in your engagement strategies.
Yeah, I'll take that one. And so we have engagement strategy explicitly looking at the SDG, using as a framework to engage with corporates. And that is actually, it's biased both towards emerging markets and to mid-cap companies. We do find that the emerging markets is a place where there is particular opportunity for to engage with corporates, working with food producers to reduce the plastics in their packaging, for example. And it is also more mid-cap biased because that is, we find there is greater cut through, greater opportunity for us to have that impact with the company we're investing in, and they really want to engage with us and have that collaborative conversation.
Mm-hmm. And what's your opinion in green bonds? Are you investing in this product?
I take that one. Yeah, we do invest in green bonds. We have mandates that we run purely green bonds for some of our institutional clients. We also have our responsible fund range includes some fixed income products, such as a responsible Euro bond strategy, and we have some green bonds there as well. We think it's a market that we want to support directly, shifting capital towards clean energy and environmental solutions. We do take a lot of care to analyze each and every green bond that we invest in to check it's actually doing what it says. Look at where the proceeds would be used. We look at the parent company. We often engage with dialogue with the company to check that we think that the bond is genuinely meeting the green bond standards out there before we'll invest.
I will ask you a couple of questions. One is recent research by Share Action shows that 51% of the biggest 75 asset managers in the world have a weak focus in sustainable investing. Is this figure surprising you? What more can the managers do to improve it with ESG? And the second one is, what is, in your opinion, the most powerful driver of ESG investment? Regulation, product offering or marketing, or demand of investors?
Shall I have a crack at those, Nick? On the first one, I think this is changing really fast. I think ESG is now so high profile amongst our clients that a lot of we've been doing this for a lot of sort of jumping onto it, which is great. We want more weight behind ESG. I think there is a difficult clients in telling who's doing it well and who's doing it badly. So we really welcome Share Action researching this. And I think there are some pointers that you can look to sort of judge whether a manager is genuine in its ESG commitment or if it's just saying that because it's good marketing. So, for example, look at the voting record. Does the voting record back up what they're doing? They're voting on climate change shareholder resolution. What's the size of the team? What's the background of the? Have a look at have a look at the stock note. If you look at a stock note, just a box on the back, or something that's genuinely integrated into the valuation, and how is it pushing that? I think there's some indicators we can look at to tell best practice, but I think the fact that this has become so much more mainstream can only be a positive thing. So the second question, what was the biggest driver? I think we see that the reason it's so big is because these drivers have come together. So regulation and the legal position that it's legitimate to look at ESG has come at the same time as increasing client demand and expectations, and also the realization that things are actually material. And I think if we'd only had one or two of those, there'd be momentum. I think genuinely the momentum has come from three of those together. Perhaps regulation has helped to pull out those who are kind of at the bottom. The laggards have helped to improve those who were being more resistant. Genuinely, they've just all acted together to force the improvement.
Nick, I think this one is for you. I mean, we are seeing great interest from investors towards passive investments. What is your opinion of passive investment in the responsible ESG space?
Yeah, and I'll try and keep it brief. Active is the right way to invest in this. One point is around the data that's sort of ESG passive strategies, as it were. We have the ongoing concerns around some of the sort of metadata that's out there, so that is where we need to. But then also taking a step back, we think that by taking a more proactive stance and a more focused stance on each of our companies, we think that actually we can really derive the best risk return profile by being very deliberate in our stock and taking a long-term view. That we think enables the portfolio to best benefit from a risk return profile, looking at multiple number of years to really to allow those sustainability drivers to bear fruit, and for that proactive engagement also bear fruit and that support.
Thank you, Nick. Based on your experience on ESG investing, which three United Nations Sustainable Development will be the most important for the next 10 years from an investor's standpoint?
I can take that just to start with. I think something we've seen, just a data point that we can watch for is the World Economic Risk Perception Survey. We saw in this year, we saw climate change in terms of both climate change, both of the likelihood and the impact, top 10 for the risks associated with that we're seeing within the environment and society. But it is the impact of climate change has leapfrogged weapons of mass destruction as to what that could do for the world around us. Now, I think climate change is, we're all aware of climate and the impact that has. That is something we continue to place a huge amount of and try to identify those companies that are mitigating that climate change impact. I'd say also good health and well-being is something that we put a huge amount of focus on the societal side. Both if we think about aging demographics, increasing obesity, nutritional issues, food more affordable. These are huge societal challenges, and so again, if we can identify those challenges, then we'll do so. And the third one I think is really important from where my perspective is responsible consumption and production. Trying to make better use of materials that we have right now, make them more renewable, and to reduce the plastics going into the ocean, the impact that has on aquaculture and so on. That again is, I think, incredibly important, and so that is why we place such importance on these areas.
Thank
Can
you.
I quickly add a thought?
Yes.
I just wanted to mention SDG 10 is about reducing inequality, and coming back to what you said about, I think the things it's done, which is really dangerous and worrying, is it's really increased inequality that was already there. But you know, in people who've been out of work, and in terms of the impact on workers, I think it's really worsened the inequality we see globally, and massively damaging implications socially. So I'd say it's not investable SDG particularly, but I think this is going to be a really important theme going forward.
Thank you very much. I think we have only time for one last question, and I think it's quite important. How can investors protect themselves about greenwashing?
So I'll take that, and I think that what really needs to be done is, as Vicki mentioned earlier, is to talk to your asset manager as best you can, or to source as much data as you can to really cut through what people may or may not be saying. The more granular an asset manager can be about their process, about the companies they're investing in and why, that will enable you to cut through some of the potential greenwashing that might exist in the market. You know, there are absolutely different products out there in the market that will fulfill the perfect role for different investors. You know, there are portfolios that will put sort of an ESG score across the portfolio to give a sense of the ESG performance of the portfolio, and that might be suitable for some clients. But we happen to think that actually the demand is there to go to be more deliberate and to have more impact, and that is why we do it. But the challenge for greenwash is to, as best as one can, to really do the due diligence into the way portfolios are managed. Why we think the onus is on us to be open and transparent as we can.
Thank you. A question from myself. Looking to our near future, next week, US elections, do you think Trump could be bad news for your ESG world?
One thing from my perspective, climate change is an issue that I work on. What's been very, if you look, one of the issues of election is climate change, and without a doubt, federal policy will go a very different way under Trump or a Biden presidency. What's been really interesting, sort of big as part of the Climate Action 1 initiative that I mentioned that we're part of, and really most of the big utility companies are in any case moving towards quite radical decarbonisation of their electricity portfolios, because it just makes sense from a risk point of view and from an economic. And so the big energy producers in the US, Dominion, Vistra, sort of major electricity producers, have all got net zero by 2050 targets and are all closing down coal-fired power. So I think perhaps of course, federal level policy is important. Actually, there are sort of big drivers towards, in the case of climate change, towards improved performance on sustainability, which don't necessarily depend on at federal level in the US.
So, Vicki, Nick, thank you very much for sharing with us all your knowledge. It has been a great pleasure for me to share these minutes with you, and I hope we will have the opportunity to talk deeper in the next future. Thank you very much for your participation. Thanks. And I will pass the lead to. Thank you. I will pass the lead to Madina so as she can close. Thank you.
Marta, Vicki, Nick, thank you so much for such an interesting event. I'm pretty sure that all our spectators, they enjoyed and had a good time by connecting to this event. I would like to remind all of you to stay in touch with Fund Society, to not miss out our future virtual events. And please follow us in social, subscribe to our YouTube channel, and also recordings of virtual. And thank you so much for being with us. Stay safe. Hasta luego.